Welcome back to the deep dive. Ready to pull up a chair?
Whoops, oh?
Because we are diving into quite a stack of source material today. We're looking at something really crucial in financial reporting, but honestly, sometimes a bit mystifying. Comprehensive income?
That's right. We're going beyond, the usual bottom line.
Net income.
Yeah, net income. We want to get the fuller picture of how a company's value actually changes over a period, specifically focusing on those changes that don't come from owners putting money in or taking it out.
Exactly. So our mission today, use these sources as our map to really unpack what comprehensive income is, how it relates to net income, and then zero in on that often tricky bit called other comprehensive income.
OCI.
OCI, right, and it's accumulated balance, AOCI. We're basically looking at the rulebook, the standards that tell companies how they have to report these specific changes in equity.
So it's all about accounting for all those shifts in net assets that aren't shareholder transactions, essentially.
Okay, let's dive in then. Where do we start? What's the foundational idea here? What is comprehensive income according to the standards?
Okay, so the core definition, and this comes straight from ASC 220-1020 in the material, is that comprehensive income is the change in equity.
Equity meaning net assets, basically.
Right, the net assets of a business during a period. But, and this is the key part, it's only from transactions and other events from non-owner sources.
Got it. So issuing new stock to raise capital, that's an owner source, not comprehensive income.
Yeah, okay.
Paying out a dividend, also an owner transaction, distribution to owners, not CI either.
Precisely. It's meant to capture all the other changes in equity during a period, everything except those direct investments by or distributions to the owners.
And the standards break this all down into two main components, don't they?
They do, yes, very explicitly. Comprehensive income is made up of two pieces. Number one, the net income or loss we usually focus on.
The bottom line again. Yeah, the result of operations and other standard income statement stuff. And number two, this other category, other comprehensive income or loss, OCI.
Okay, OCI. This is probably where, people see a line on the financial statements and maybe just gloss over it or scratch their heads a bit. What is it? Why separate it out from net income?
Well, OCI is basically a holding category. It includes certain revenues, expenses, gains, and losses that are part of the total change in the company's equity for the period, but, and this is the critical distinction, the accounting rules specifically exclude them from being reported in net income for that particular period.
Ah, okay. So they're real changes in value the company experienced.
Definitely real.
But the rules say, hold on, don't put this in earnings just yet. Why? Is it because they're maybe less certain or temporary or unrealized?
That's often the rationale, yes. Think of them as specific types of value changes that haven't hit the threshold for being included in traditional earnings yet. The standard, ASC 220, wants transparency, so it requires companies to list these OCI items out separately.
So you can see what's driving those changes.
Exactly. And ASC 220-10-45-10A gives us the main list.
Okay, let's look at that list. What kind of things typically end up in OCI?
Well, one of the big ones the sources mention is currency translation adjustments.
Ah, foreign currency effects.
Right. If a company has operations overseas, say a subsidiary in Europe, they have to translate that subsidiary's financial statements from euros back into US dollars for the consolidated report. Changes in the exchange rate between the euro and the dollar cause gains or losses on that translation.
And those go into OCI?
They typically do, yes.
Yeah.
Because they're generally considered unrealized until maybe the subsidiary is sold or liquidated. So huge swings in exchange rates can create big OCI numbers for multinationals.
Makes sense. Seems volatile, maybe not directly related to the core operations performance in that period.
That's part of the thinking.
Yeah.
Then you have items related to hedging activities, specifically certain gains or losses on derivatives used for hedging.
Hedging, like managing interest rate risk or currency risk?
Exactly. Things like gains or losses on derivatives designated as cash flow hedges or hedges of a net investment in a foreign operation. The accounting is complex, but the idea is often to defer the gain or loss in OCI so it could be recognized in earnings later, hopefully matching when the item being hedged affects earnings.
Okay, so timing is key there, matching the hedge to the hedged item. What else is on the list?
Another one, and this is a bit more esoteric perhaps, it's changes in the fair value of certain liabilities, where the company has chosen the fair value option, but only the part of the change that's due to instrument-specific credit risk.
Whoa, okay. Break that down. So changes in the value of a company's own debt.
if they measure that debt at fair value.
And the value changes because the market thinks the company itself is more or less risky.
Right, changes in their own credit spread.
That change in value goes to OCI, not net income.
That specific slice of the fair value change, yes. The part attributable to the change in the company's own creditworthiness. It's definitely a specific accounting rule. Prevents companies from booking income just because their own credit standing worsened, making their debt cheaper to potentially buy back.
Huh. Okay, that is subtle. What else?
A very common one. Unrealized holding gains and losses on available-for-sale debt securities.
Okay, so investments in bonds and simile debt instruments.
Right. If a company holds these bonds and intends to possibly sell them before maturity, they're often classified as available for sale. Changes in the market value of those bonds, while the company still holds them, go into OCI.
So unrealized gains and losses.
Exactly. This is different from when they actually sell the bond. That realized gain or loss does go into net income. Or if there's a credit loss on the bond, that also generally hits net income now under current rules. But the day-to-day market fluctuations while holding OCI.
Got it. Unrealized in OCI, realized in net income. Any other big ones?
The last main category is usually related to pensions and other post-retirement benefits.
Like healthcare for retirees?
Yes, those kinds of plans. Specifically, certain gains or losses that arise from changes in actuarial assumptions like life expectancy, discount rates, expected return on plan assets, or differences between expected and actual returns that are not immediately included in the net periodic pension cost that flows through net income. They get parked in OCI first.
Okay, sort of smoothing out the pension expense volatility in net income.
That's essentially the effect, yes. Deferring some of that volatility in OCI.
All right, so that's a pretty good rundown of what is typically OCI. Currency, hedges, own credit risk changes, unrealized gains on AFS debt, pension adjustments. The sources also mention things that aren't OCI, right, even if they change equity.
Correct. ASC 220, 10, 45, 10B clarifies this. Some things bypass both net income and OCI, going straight to equity accounts, like issuing stock that increases additional paid-in capital, APP, buying back treasury stock that adjusts treasury stock, and maybe retained earnings, or AP. Certain tax benefits related to employee stock options sometimes go straight to AP. Or correcting errors from prior periods, those usually adjust retained earnings directly. They're not part of comprehensive income calculation.
Okay, so OCI is this specific defined middle ground. It's not current net income, but it's also not a direct owner transaction or correction. Fascinating. So how do companies actually present all this? Show it to investors.
The standards give them options. ASC 220 allows for two main presentation formats, and the source material, like in that figure FSP 41, illustrates them.
Okay, what are the choices?
Option 1 is a single statement approach, a statement of comprehensive income.
All in one place.
Exactly. You basically have your regular income statement items leading down to net income. Then, right below net income on the same page, you list out the individual OCI components for the period, the currency adjustments, the unrealized gains, etc., maybe net of tax.
And then you sum it all up.
Right. You add or subtract those OCI items from net income to arrive at a final line. Total comprehensive income for the period.
Seems clean. Simple.
Proponents like its simplicity. Everything's there. Option 2 is the two consecutive statements approach.
Okay, so statement 1 is?
Statement 1 is just the traditional income statement. It ends, as usual, with net income.
Got it.
Then, immediately following it, maybe on the next page, you have a second, separate statement, the statement of comprehensive income.
And how does that one start?
It starts with the net income figure from the first statement. Then, it lists out all the OCI components for the period, just like in the single statement format, adds or subtracts them, and arrives at total comprehensive income.
So that way net income still gets its own spotlight, kind of.
Exactly. Supporters of the two-statement approach argue it preserves the prominence of net income as, maybe the primary performance measure, while still providing the full comprehensive income picture right after.
Makes sense. Different emphasis. Is there a requirement for, comprehensive income per share? Like
Yeah.
EPS?
Interesting point. No, the standards explicitly do not require companies to disclose total comprehensive income per share on the face of the financial statements, just the total amount.
Okay, good to know. So that covers how CI and OCI are reported for a given period. But these OCI items, they don't just disappear, right? They build up somewhere.
Correct. And that brings us to accumulated other comprehensive income, or AOCI.
AOCI, the accumulation.
Exactly. Think of OCI as the flow during the year,
Yeah.
the changes happening in that period. AOCI is the reservoir, the running total. It's a separate component of shareholders' equity on the balance sheet.
So it sits there alongside retained earnings, common stock, API.
Precisely. It represents the cumulative amount of all those OCI items from the current year and all prior years that haven't yet been dealt with or moved elsewhere.
Moved elsewhere, like into net income.
Exactly. This is where the concept of reclassification adjustments comes in. It's sometimes called recycling.
Recycling OCI, I've heard that term. What does it mean?
It's a crucial mechanism. Reclassification adjustments are amounts that were recognized in OCI in a prior period, and therefore are sitting in AOCI on the balance sheet, but are now being moved out of AOCI and into net income in the current period.
Why move them?
Usually because the underlying event that made the item unrealized or deferred has now occurred, making it appropriate to recognize it in earnings. The key reason for the adjustment is to avoid double counting.
Double counting, how so?
Well, take our available-for-sale debt security example. The unrealized gain went into OCI when the bond's value went up. Now you sell the bond, the realized gain hits net income. If you didn't remove the previously recognized unrealized gain from AOCI, that same economic gain would effectively be counted once in OCI in a prior period and again in net income in the current period. The reclassification adjustment takes it out of AOCI when it goes into net income.
Ah, okay. It clears out the AOCI balance related to that specific item as it flows through the P&L. That makes perfect sense. So it's like a temporary holding tank for some items.
For some items, yes. Not all OCI items get recycled, but many common ones do, like the realized gains losses on AFS debt securities when sold, or the deferred gains losses on cash flow hedges when the hedge transaction finally affects earnings.
How do companies show these recycling adjustments? Is it obvious?
The standards require transparency here. Companies need to show the amount being reclassified out of each component of AOCI. They can do this in a couple of ways, as the source material, like FSP 42546 suggests. They can show the reclassification amount right on the face of the statement of comprehensive income, often parenthetically within the line for that OCI component. Or they can show the OCI component's gross and provide the details of the reclassification adjustments of the footnotes to the financial statements.
So either way, the information should be there if you look for it.
It should be, yes. The goal is clarity on what's moving from AOCI into net income each period.
Got it. Now, what about taxes? These OCI items presumably have tax implications too.
They certainly do. The presentation rules require companies to show the income tax effect related to each component of OCI.
How do they do that? Show the tax for each line item.
They have a choice. They can either present each OCI component net of its related tax effect right on the face of the statement, or they can present all the OCI components gross before tax and then show a single aggregate line item for the total income tax expense or benefit related to all the OCI items combined.
Okay, either net or gross with a total tax line.
Right. And importantly, those reclassification adjustments we just talked about, they also need to be shown net of their tax effects, or the tax effect needs to be considered when reconciling.
So the tax follows the item when it gets recycled too.
Exactly. The tax effect moves from AOCI to impact the income tax expense related to net income. And the source material also mentions a specific update, ASU 2018-02.
Right, related to tax reform.
Yeah, the 2017 Tax Act in the U.S. significantly lowered the corporate rate. This created a problem where deferred taxes sitting in AOCI related to OCI items were recorded at the old higher rate. They became sort of stranded excess tax effects.
Ah, so the underlying OCI item hadn't been recycled yet, but the tax rate changed.
Precisely. So ASU 2018-02 gave companies an option to reclassify those stranded tax effects from AOCI directly to retained earnings, bypassing net income, just to clean it up without distorting earnings. A practical fix.
Interesting. Shows how tax law changes ripple through these specific accounting areas. Okay, let's touch on a couple of other specific situations the sources mentioned. What about companies that don't own 100% of their subsidiaries, non-controlling interests or NCI?
Good question. If a company consolidates a subsidiary but owns less than 100% of it, it has to allocate comprehensive income between the parent shareholders and the non-controlling interest holders.
Does that apply to OCI too?
Yes. The standards require the company to present, either on the face of the comprehensive income statement or in the notes, the portion of total OCI for the period that is attributable to the NCI.
So you can see how much of that OCI belongs to the parent versus the minority owners?
Exactly. Transparency again.
Okay. And spin-offs. When a company spins off a division or subsidiary into a new, separate company, what happens to the AOCI?
That's a tricky one. The guidance generally says that the spun-off entity, the spinnee, should record the AOCI balances, that relate directly to its specific assets and liabilities as of the spinoff date. It carries its historical AOCI with it.
Makes sense. It relates to its ongoing business.
But there's a key exception highlighted. Currency translation adjustments, the CTA.
From the foreign subsidiaries.
Right. Any CTA that existed in the parent's AOCI before the spinoff, resulting from the parent consolidating that subsidiary. That CTA does not typically transfer to the spinnee's opening balance sheet AOCI.
Why not?
Because that CTA arose from the parent's perspective as the investor translating its investment. It doesn't really belong to the standalone spinnee's equity structure going forward. It usually stays with the parent or is eliminated as part of the spinoff accounting at the parent level.
Okay, a specific carve-out for CTA and spinoffs. Good to know. And just to confirm, these rules we've been discussing, OCI components, presentation, AOCI, recycling, this applies to everyone, or just big public companies?
Oh, the sources are clear. These requirements in ASC 220 apply to both public and private reporting entities.
So relevant across the board.
Very much so. And as we saw, was mentioned those ASUs like 2017-07, 2018-02, 2018-03, 2018-09. This is clearly an area where the standard setters are actively refining the rules around OCI presentation and reclassifications. It evolves.
It definitely seems like an active area. Okay, wow. We have covered a lot of ground here.
We certainly have.
We started with comprehensive income being net income, plus this other bucket, OCI. We unpacked the main things that go into OCI currency adjustments, certain hedges, unrealized gains on available for sale debt, pension stuff, even that quirky own credit risk item.
Right.
We looked at the two ways to present it, single statement or two statements. Then we dove into AOCI, the cumulative balance on the balance sheet, and that really key concept of reclassification adjustments or recycling, moving items from AOCI into net income when they become realized.
And don't forget the tax effects that follow along.
Absolutely. The tax implications are crucial. And we touched on NCI and spinoffs. You know, stepping back, understanding all these layers really does give you a much more complete view of how a company's financial position changed, doesn't it? It's more than just the net income number.
Absolutely. It captures value changes, market volatility, things that definitely affected the company's net worth during the period, even if they didn't flow through the traditional earnings per share calculation yet. It signals things about future earnings or risks.
It really broadens the perspective. So here's a final thought to leave everyone with, something to chew on. Thinking about this whole system, especially OCI, and the idea that some amounts sit there temporarily before being recycled into net income later. What does that tell you about the concept of timing in financial reporting? How does acknowledging OCI maybe change how you think about a single period's reported net income versus the company's, well, total comprehensive performance over a longer stretch?
That's a great question. It really highlights that net income is just one piece, often focused on more realized transactional results for the period. OCI captures other economic realities, often unrealized or longer-term adjustments. It reminds you that the full financial story often unfolds over multiple periods, and AOCI is tracking part of that unfolding story.
Net income as a snapshot, comprehensive income as maybe a bit more of the motion picture. Something to definitely keep in mind next time you're looking at a set of financial statements. Thanks so much for walking us through all that today.
My pleasure. Always enjoy diving into the details.